too many investors try to time the market and then they fail. They should probably have a different strategy. And I'm going to share the strategy that they probably should have with you right now. Hello everyone, my name is Zach, and welcome to On Cash Flow, where I help you become a master of your own cash flow. Now let's get started. The short answer to the best time to buy stocks is that you should be dollar cost averaging your way into the stock market no matter what it is doing. Whether it's up, whether it's down, whether it's sideways, meaning put a set amount of money that you plan to invest every single month and just invest it. This is the best way for you to buy yourself into the stock market. Now, it should go without saying that there is a lot more to investing than simply just investing in something and then putting it on autopilot. And that's why I have a full guide for you on investing your way to achieving financial independence. But I'll mention that at the end of this video. Let me first give you some really compelling reasons on why you should dollar cost average your way into investing in the stock market rather than trying to time the stock market. And the very first one, I just have to get it out there, and that is that market timing, like really good market timing, is practically impossible. It's literally inconceivable for you to be perfectly timing the market. It's even impossible for you to just do it well rather than, forget perfect. It's really difficult for you to just time the market well. Another reason why dollar cost averaging is better is that it is simpler. It's much more easy to follow. Along with that, it's also a lot less stressful. It's a lot less stressful because you know exactly how much you're investing. You know this is the plan. You know that investments are going to go up and down in value, but regardless of what's happening, you're investing this set amount, let's say every single month. And so that is a lot less stressful. And last but certainly not least, did you know that dollar cost averaging is probably going to actually make you richer than even if you were able to perfectly time the market? You would probably have a lot more wealth if you were to just dollar cost average your way into the stock market. Now you know the best time to buy stocks, but did you know the best time to like this video is right now? No, seriously, if you're enjoying this video so far, please make sure you like the video. Please give it a thumbs up. It really does help me out, and I would really appreciate that. Plus, it's also going to help you out. That's because YouTube is going to be like, hey, this person likes on cash flow videos. Maybe I should recommend more to them. And I would highly suggest that the algorithm do that for both you and I. Okay, but seriously, how is dollar cost averaging going to make you richer than perfectly timing the market? Why are so many people trying to perfectly time the market if they would have been richer if they just dollar cost average anyway? Well, that's because they don't know about this study done by the Personal Finance Club website. They have a really cool little article where they did a little calculation on 3 different scenarios. In these 3 different hypothetical scenarios, you have someone who is the worst market timer in the world. So literally this person, they bought when the market was at its peak, so when it was as high as it can be, and then they sold when it was as low as it can be. And during that time when they took the money out of the market, they had it in a regular savings account earning 3% interest. So this person did the exact opposite of what you would want to do if you were market timing, and they paid the price for it. The second hypothetical scenario, this person was the perfect market timer. They were the absolute best at buying when the market was at its very low and selling when the market was at its very high. And in the meantime, while they were waiting, they had their money out on the sidelines, putting it into a savings account earning 3%. And then you have scenario number 3. There was a person that said, I don't know what the heck the market's going to be doing. I'm just going to set up this amount of money to invest every single month. I'm going to leave it alone and not touch it. And guess who of the 3 had the largest net worth at the end of the time period? I believe it was 40 years of investing. Well, you probably already know the answer to that based on what I've been saying up to this point, and that is the person that dollar cost averaged a certain amount of money every single month. They had the highest net worth at the end of a 40-year time period. And the crazy thing was all of them invested the same amount of money. Out of their pocket, all of them put in $96,000. However, the person who dollar cost averages and didn't take their money out of the stock market had the highest ending balance, even more so than the perfect market timer, which, by the way, I will remind you is impossible to do. And now this leads me to a big question that I have for you. What is your investment plan when it comes to making your contributions to your investments? Do you follow the dollar cost averaging plan here, or are you trying to time the market a little bit? Please let me know in the comments below. I'm really curious to find out what your investment strategy is. But I don't want to end it there, because there is a situation in where dollar cost averaging is actually not the right choice for you. And that is if you have a large amount of money to invest. So if you get a lump sum, it is actually better for you to put that money into the market right away, statistically speaking, than it would be for you to dollar cost average that money into the stock market. So for example, if you got, let's say, a extra generous bonus at work, or maybe you got an inheritance, or maybe you won a small lottery. If you have $100,000 that you all of a sudden came into and you're like, hey, I'm going to invest this $100,000, it's actually most likely better for you to invest it all at once rather than to put a certain amount every single month into the stock market. And this mostly has to do with the stock market having an upward bias, which means that most of the time, over long periods of time, time, the stock market is going to be up, especially when you're talking about longer time periods, such as 10-year rolling periods. A study done by Vanguard, which was published in 2012, looked at lump sum investing versus dollar cost averaging and found that about 2/3 of the time, it would have been better for you to just put all that money into the stock market right away as a lump sum investment. So if you do come into contact with a large amount of money that you're willing to invest, it's most likely going to be better for you pretty much 67% of the time to just put it all into the stock market all at once. However, for the rest of us, we usually get a small amount of money every single month, whether that be from a job, from our business, or something like that. We usually don't receive lump sums. So it's better for us to just invest what we can invest every single month by using dollar cost averaging. Another thing that is going to be best for us all is to watch my complete guide to investing your way to financial independence. If you haven't watched that video already, you definitely need to watch that video. Okay, I'm going to put it in a link in the description below, a link in the pinned comment below, and I'm going to put it on the screen right after I get off the screen. Thank you so much for watching this video. I'm Zach from OnCashflow.com, and I hope to see you next time.